So you're in the process of buying a home and you're hearing all these words that you have no clue what they mean being said by both your mortgage lender and your realtor. So I'm here to help you understand exactly what they mean. I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers in my 22-year career, and today I'm here to help you. So let's get down to the basics. So you're going through the mortgage process and you hear things like DTI and LTV and gross income. But what do those things even mean, and why do lenders and realtors care about those things? Well, I'm gonna help you understand that. So let's start with DTI. That's a very common thing that you'll hear in the mortgage industry. It would be thrown around while you're going through the process. And I try to teach this to my team that when they're having conversations with clients, especially first-time home buyers, meaning you've never been through the process before, to make sure that we explain and they explain what those things are, rather than just saying, oh, you're DTI, or we need to keep the LTV at this level, or right? Well, what do those acronyms even mean? So let's start with DTI. So DTI stands for debt to income. And what it is it's your debt compared to your income on a monthly basis. That's what we as lenders look at when we're qualifying you for a mortgage, right? That's just one aspect of what we look at. What I mean by that is this. Let's just say that your monthly debt, meaning your bills on a monthly basis plus the new property you're buying. So let's just say that number was $2,000. This is your debt. Not the balances on your debt, the payments on your debt. And then we do a comparison between that and your income. So let's just say your income was $6,000. Well, 2,000 into 6,000 would be 30%. This would mean that you have a 30% DTI, debt to income ratio, right? So that's what lenders mean when they say DTI. Let me grab my eraser real quick. That's one thing that lenders look at. That's something you're going to hear. So hopefully this helps you understand what that means when they throw the word at you. So that way you have a better understanding of what the heck they're even talking about, because let's just assume you don't, right? The more you know, the better it is. Next, another acronym you're going to hear a lot of when you're going through the process is LTV. What LTV stands for is loan to value. This is another ratio, but in this case, it's dealing with the property that you're buying. So your loan to value is the percentage of the property value to which you're purchasing. So loan to value example, if you're putting down, let's say your down payment equals 5%, well, then your loan to value equals 95%, right? These two numbers together should equal 100% of whatever the purchase price is. So in this case, it's 95%. If you were putting down 20%, your loan to value would become 80%. 20% plus 80% equals 100%. That's what loan to value means. All right, so we have DTI, we have loan to value. Now let's talk more about the income piece, which has to do with your DTI, because you're gonna have your lender telling you, oh yeah, we're gonna use this income or that income. So a lot of comments I get on the videos that I do for Instagram and TikTok, where I'm showing people what they qualify for based on a specific dollar amount they make per year or amount they make per hour, is I get a ton of comments telling me, oh, that's not right, that's the gross income. Well, yes, it is the gross income. And what is gross income, right? So gross income, and I'm not talking about something that's disgusting, right? Gross income is pre-tax. Your income before taxes are deducted. And believe it or not, although that's not what you take home and have available to pay your bills with, your gross income is what lenders use to qualify you for a mortgage. So for example, if you make $120,000 a year, this is your gross, and you pay taxes obviously, just like we all do, right? So let's just say that your take-home income on that is $85,000 a year. This is known as your net income, right? This is what you actually take home. A lot of people think that we would use this number, but we don't. We actually use this number toward qualifying. By we, I mean lenders. Lenders are always going to use your gross income toward qualifying. That's your taxable income. So gross income, when you hear your lender tell you that, or you're filling out a loan application and maybe they're not doing it with you by phone. I prefer to do it by phone with my clients to walk them through it. but maybe you're filling it out for yourself, make sure that you're entering your gross income, not your net income on that loan application, because obviously that can make a big difference in your DTI, debt to income ratio, which is going to compare your gross income to your monthly bills, right? Versus your net income to your monthly bills. If you did your net to your monthly bills, you're going to have a much higher DTI, which is going to make it harder for you to qualify. So keep that in mind if you're going through the loan application by yourself. Maybe you get an online link, whatever it is, make sure you're using the correct numbers. If you're self-employed, it's a little bit different. You're going to use your gross income, but it's your gross income that you're taxed on. So it's your adjusted gross income, right? So make sure you're doing that properly if you're self-employed. And if you want more details on how to do that, check out my video on self-employment specifically. Now, what do lenders look at when it comes to your monthly liabilities, right? So we talked about DTI, which involves your liabilities, one of those liabilities being the new property you're buying. But what about your other liabilities that are already on your credit report? What do lenders look at? There are often times that I'll talk to a first-time home buyer and I'll say, tell me about some of the debt that's on your credit report. Credit cards, student loans, any sort of installment loans you might have, right? Things that report to credit. We're not really concerned about things that are not on credit other than maybe alimony or child support, right? But things that are on credit. And so oftentimes a first-time home buyer tells me, oh, I have $2,000 a month in credit cards. I'm like, okay, $2,000 in credit cards. And I have $100,000 in student loans. Okay. It's a lot of student loans, but it's pretty common, right? And I have a car loan that has a $30,000 balance on it. Okay, $30,000 car. They say, yeah, I don't know how I'm going to qualify with all of that. Well, we as lenders don't necessarily look at the balances in your debt to income ratio, right? So what we're actually going to be looking at is what your minimum monthly payments are on those debts. So $2,000 in credit card debt. Well, that's not the monthly payment. As a lender, all we care about when it comes to calculating the debt to income ratio when we're looking at your liabilities are the minimum monthly payments for your debts. So $2,000 in credit cards, well, maybe the monthly payment on that is $75. $100,000 in student loans, maybe these student loans are deferred. You're not making any payments. Well, we're going to use some sort of payment on that realistically. So let's just say that we're going to use 0.5% because we're doing an FHA mortgage. And check out my videos on how student loans are calculated depending on the type of loan you're obtaining. But in this case, let's just say that we're doing an FHA loan and we would use 0.5%, which would be $500 per month. And then you have a $30,000 car loan, but your payment on that car is $400. So we would take these, add them together, is $975 per month. This is what lenders care about when they're looking at your liabilities. The payment, not necessarily the balance. Now, in some cases, of course, the balance dictates the payment if we're having to use a percentage. However, in most cases, there's a reporting payment for things such as a credit card or a car or an auto lease, right? So keep that in mind. Don't think just because you have relatively high balances in your mind on your monthly liabilities or on your debts on credit, that it's going to prevent you from buying. Like I said, we don't necessarily go off the balance, we go off the minimum payment required on those things. So don't let that deter you from buying. Now, another thing that comes up often are property types, right? So you might hear someone say single family residence, right? SFR, or SFH, which is a single family home, or PUD, which is a planned unit development, a townhome, a condo. You're gonna hear these words. So a single family residence and single family home are the same thing. It's a freestanding home. Just think of a house, right? Just a regular house that's not attached on either side, no one above, no one below, right? It's just a house. That's a single family home. A PUD is typically gonna be freestanding as well. So picture that same house, but it has a homeowners association fee. So it's a single family home, not attached, up, above, below, side or side, but it has a homeowners association. So it's in a development where you're having to pay to live within that development, right? That's a PUD. Townhome is gonna be, it could be, I don't know, various stories, usually 1 to 3 stories, and it's attached. And then condo is picture like an apartment, right? It can be a high rise, it can be a mid rise, a low rise, right? So it's gonna look a lot like an apartment, a condo. Now, here's something that comes up at times that is confusing for a lot of borrowers and a lot of realtors. There are times where this townhouse, right, it physically is a townhouse, right? You're picturing in your mind like a 2-story, like row of homes, right? That's a townhome in my mind, right, physically. However, there are times where this townhouse is actually a condo because it's deeded as a condo, meaning when the builder built the property, they deeded everything as one. Supposedly that saves them money, but it will affect the type of financing you can obtain on that property. So understanding the type of property you're buying and how it's classified is very important. And you can actually check to see if it's a condo, a townhome, a PUD, single family. You can determine all that by going onto the county website for whichever property you're interested in. And if you go to that property address specifically and look at the property detail card, it will tell you how the property is classified. So this way you know if you're approved for an FHA mortgage, for example, that you should only be looking typically at these types of properties, right? You should try to keep condo out of the picture because condo financing on FHA mortgages is a lot more difficult. You're just more limited. So something to keep in mind. That leads me into FHA. Sure, you've heard of an FHA mortgage, and you're probably thinking to yourself that FHA stands something to do with first-time home buyer, right? But that's actually not what it stands for. So it stands for the Federal Housing Administration, not first-time home buyer. Now, it's used by a lot of first-time home buyers, don't get me wrong, but it's actually maybe come as a surprise to you that FHA loans are not just for first-time home buyers. They just have to be used for the purchase of a primary residence, which means it's a home that you plan to live in year-round. Doesn't mean you have to be a first-time home buyer. So that's extremely important. You want to keep that in mind. You may hear conventional or conforming or non-conforming. Conventional, conforming, non-conforming. These are all types of loans. A conventional loan is a loan that meets just traditional lending requirements. Think your standard, as a first-time buyer, you can do 3% down, but think somewhere 5% plus typically, right? If you're not a first-time home buyer. In your case, you are, so you can do 3% down. But conventional loan, that's your loan amount, is just pretty basic type of loan. Conforming loan is hand in hand with conventional, but what makes a loan conforming is typically going to be the loan amount, right? So there are loan limits throughout the United States. Most of those on a conforming loan are going to be capped. This is for 2025 at $806,500. Not purchase price, loan amount. That means that if you borrow up to that amount, you're getting a conforming loan. However, you can get loans that are over this amount. Those are called non-conforming. You may have also heard the term jumbo. Jumbo and non-conforming go hand in hand. A jumbo loan is any loan that's 806, 501 or more right now, at least for 2025. This number increases year over year just based on the area median home prices. But in 2025, as I mentioned, this is what the cap is for a conforming loan. So if you hear this terminology, conventional, conforming, non-conforming, jumbo, you have an idea of what that actually means. One more I want to give you that's common is going to be ARM. You're going to start seeing more ARMs coming up now that rates are improving a little bit. What an ARM stands for is adjustable, it's the A, rate mortgage. Adjustable rate mortgage. So fairly simple. I mean, this first word should tell you everything. The rate's not fixed. The rate can change, but doesn't mean it changes daily, doesn't mean it changes monthly or yearly. Most adjustable rate mortgages have a fixed period of time at the beginning of the loan. The most common fixed periods are 3, 5, 7, and 10 years. So fixed for the first 3 years, fixed for the first 5 years, fixed for the first 7 years, or fixed for the first 10 years. The shorter the fixed period, the lower the rate will tend to be. These are 30-year mortgages. So the monthly payment is still based on 30 years, just the rate will not stay fixed for all 30 years. So just keep that in mind. But it's a good option if you plan to refinance after a short period of time, or you don't plan to keep your property the full 30 years, as most people don't. Maybe you know that you're only going to be in this property for 10 years. Well, you might want to look at doing an adjustable rate mortgage that's fixed for 10 years because you might be able to save some money on the interest rate. It hasn't been like that for the past 3-4 years. However, it's starting to get to be like that a little bit more now, where you might be able to save 0.25% on the interest rate for the first 10 years. And if you know for sure you're not going to stay there longer than that, it's a great option. If you're planning to stay there longer than that, just keep in mind, after the fixed period of time, the rate can go up or down depending on what the market's doing. And since none of us have a crystal ball, always bank on up. So you don't want to take that risk if you know that you're going to be keeping the loan that full time. So there's a lot more that you can take the time to learn when it comes to mortgages, terminology you should expect to hear, and hopefully what I shared with you helps give you a good glimpse into what to expect and helps you as you work through that process and understanding what the heck everyone is even talking about. But if you want more information on mortgages, make sure to subscribe to my channel where I give detailed information on every aspect of both the real estate and the mortgage process. And leave a comment below if you have questions about your own scenario. I do reply to 100% of the comments left on my videos.